Gold was supposed to go up. War started, fears floated, price pumped to 5,600, and then it crashed to 4,400. So what really happened? Hello traders, welcome back to Nova channel, and let's continue another new topic today. When the Iran conflict began, gold reacted exactly how everyone expected. Fear hit the market, or surged. Everyone rushed into the safe haven assets. Gold rallies aggressively, pushing the over $5,400 and even toward $5,600 as war tension escalated. At that moment, the narrative was perfect. War, which meant buy gold. That is exactly why the move didn't last. Because markets don't reward obvious ideas, they punish crowded ones. As the gold kept rising, more traders jumping in. Breakout buyers, late entries, for more positions, liquidity started building below the market. And once positioning became too one-sided, the market shifted. The drop from 5,600 to 4,400 wasn't just panic. It was a combination of macro pressure and market mechanics. First, US dollar got stronger. During this war, capital didn't just flow into gold, it also flowed heavily into the dollar as a safe haven. And when the dollar rises, gold becomes the weaker. Second, it is interest rates and bond yields increased. Our prices surged because one of the conflict pushing inflation higher. That forced expectations of higher interest rates, and higher rates are bad for gold because gold doesn't pay yields. And third, profit taking and forced selling. Gold had already rallied massively before the crash, so when volatility hit, big players started taking profits. At the same time, margin call forced traders to liquidate positions, accelerating the sell-off. And when gold gets sold to cover losses elsewhere, it drops fast. This creates the biggest misunderstanding in trading. People think war, which means gold must go up. But the reality is, gold reacts to positioning, liquidity, and macro forces, not just headlines. In fact, this kind of move is not new. Gold often spikes first on fear, then drops when the market starts adjusting. Because the first move is emotional, the second move is structural. And that's exactly what you are seeing here. The move to 5,600 was driven by fear. The drop to 4,400 was driven by repositioning, liquidity grabs, and macro pressure. For trader, this is the real lesson. The market doesn't move based on what should happen. It moves based on what will trap the most people. So next time, go spike on the big news. Don't just follow the story, watch the positioning. Because the biggest moves don't happen when everyone is afraid. They happen right after everyone feels certain. And that is the topic today. Thank you so much for your watching. And don't forget to like and subscribe Nova channel to receive more useful video for your trading journey. Happy trading and see you in the next video.